Welcome, welcome, welcome. Raising capital, boy, that is it's a tricky thing in these environments. This is a free training. We do different types of free training every single month. Um, and the one that I would recommend is Gather and Grow. It's usually our largest event. There's usually anywhere from 50 to 70 founders on that call. It's a great brainstorming event. It's a great networking event. So I highly recommend that. And then on September 25th, we have another training event on purpose and profit and how to balance both of those, which is also a passion of mine. I'll just say just a tad bit about ShiftCo, and then we'll jump into how to raise capital. We train conscious entrepreneurs how to grow their business and maximize their impact. And we take that very seriously. 88.9% of the members who join ShiftCo double their revenue. And most of them do that in a very short period of time. And we believe when you double a business, you triple its impact. So we're very dedicated to that. What brought me to this is I've had multiple large exits, which means I've grown a company and sold it, including an initial public offering on the NASDAQ stock exchange. So I've been doing this for a while. I'm actually over 60 now, so I've been doing this for a long time. And then in 2009, I had this revolution that I sold a very successful business, started over with this crazy idea. There has to be a way to do good and make money. And I wanted to use my business growth skills to make the world better. So I set up the equivalent of a purposeful Shark Tank. It's called Share on Purpose. And that logo represents a dollar sign, since I live in the US, with people working together and collaborating, which is really my vision. We have what we call the Speculator. It is an investment fund where we leverage profits. An example of what we invest in is Your Izzy, which is the first zero waste makeup and skincare line. So we are very passionate about sustainable brands. And that was one of the things that we invested in through the Speculator Fund. We also have what we call the Cultivator, and the Cultivator creates our own companies. And we have 5 of those. Here's an example of 4 of them. ShiftCo was actually one of those brands. So needless to say, I've dedicated my entire life to entrepreneurship. I have the best job in the world because I get to grow things that matter. And I love what I do. So that's enough about me. If you were drawn to ShiftCo, and particularly this session, more than likely you're needing to raise capital or you're struggling with cash flow or something along those lines. But the other thing that's unique about ShiftCo is something called conscious entrepreneurship. What that means is conscious entrepreneurs want to build a business and make profit and make money, but they also want to make a difference. And that's important because it's a business model unto itself. And I'd like to distinguish what I mean by that. So on the right side are the way traditional businesses think. Who will buy what I have, as an example. On the left side is the way that people like myself think. Rather than thinking who will buy what I have, what I really think about is who do I really want to serve, not who will buy what I have. It's really about who I want to serve. And I've dedicated my life to serving conscious businesses and helping them grow profitable, thriving companies. Back to the right side, when they build a product, a traditional founder says, will somebody buy this product? Whereas a conscious founder says, will this solve a problem? And you could go on and on with all of these, but it gives you an example of what we mean by conscious entrepreneurship. And it's different. It is really about doing well by doing good work and serving people in meaningful ways. It's a noble calling. And I had my own conscious entrepreneurship epiphany in 2008 when I began to sell the business I had, which was not focused on doing good. It was focused on making money, it was specifically set up to make money. And I felt like my soul was dying in the process. So I've dedicated my life to using my business growth skills to do good. And so we at ShiftCo, we show people how to build profitable businesses doing good. Okay, so enough about me, enough about ShiftCo. Let's talk about funding, which is why you are here. First of all, not all funding strategies are the same. So here's some terms. You might have heard these terms. investor, venture capital. There's others, angel funds, grants, credit, self-funding, private equity. The first point that I want to help you understand is these are not equal. And there's a distinct difference between the type of funding you want to raise and what it is that you want to do with that funding. So what do I mean by that? Well, first of all, there are different types of conscious businesses. So most people start and the work itself is meaningful and most of their ideas are there. The problem is you can't make money if you stay there. That means you're doing good, you love what you do, but you're not necessarily going to make money. If you start really serving people in a way that creates meaning, you kind of become a heart-centeredpreneur, which is still a great place to be, but it's not necessarily where wealth is created. Where wealth is created is when you're able to scale your impact. And why that matters is that the types of funding are different depending on which of these boxes you land in. So if you're here, it's very hard to get funding if you're there or here, very hard to get funding. But if you can scale what you have up here, it's a lot easier to get funding. So, and I'll talk about the different types of funding and what that means in just a minute. So kind of take a moment and just kind of think about where you are in your journey. If you're just getting started with an idea, so you're down here, even if the idea is a big idea and it's going to make the world better, it's very hard to get funding if you're there. It's a little bit easier to get funding if you're here, but still difficult. You really have to figure out how to get into these upper two boxes. That's what makes it easier to get funding. And by the way, we will stop throughout here and ask questions. So if you're down in the bottom, you're going to probably have to do what's called self-funding. And as you move up this line, that's when your business idea becomes what's known as investable, meaning somebody is going to be willing to invest in that business idea. So I'm not going to get too far into how do you move from the bottom to the top, because I really want to focus on the different types of funding. But just know that there's a distinct difference between the lower two boxes and the upper two boxes. Okay, now the next point is, and this was probably one of the most difficult lessons that I had to learn early in my career, and that is that you are your first investor. And we forget this because we're like, oh, I need to raise money for my business, but you are your first investor. Most private equity companies, most angel investors will not put money into your business unless you have put money into your business. And that's one thing most people don't understand, because they think that they can magically go raise a grant and get money, or get an angel investor, which is kind of a name that's an oxymoron, to just put money into the business. So you've got to think like an investor from day one. What are you willing to invest in your business? And if you're not willing to invest something in your business, it is going to be a flag to anybody else. And then the second thing an investor says is not only what am I willing to invest, but what is the return that I actually want to get? And you've got to be thinking about that. So is it a 2x return? So if I put in $10,000, I want to get 20,000 back. Is it a 5x return? That multiple really matters. So A, you're the first investor, you have to be willing to put money in. And B, you should know from the get-go the type of return that you want to get for yourself as well as anybody that invests, even if it's a grant. A lot of people think they can just go get a grant and not have to pay it back. Those days are sadly gone. And most of the grant funding has disappeared. So you've got to look for other sources. And most of the types of funding sources, they're going to want to get a return. All right. So next thing is these different types of funding, how they manifest. So the idea, you can't just have a big idea. It's got to be able to turn into a tangible business ROI. If you don't know what ROI means, it's return on investment. So it can't just be a big idea. It's got to be able to get an ROI. So you want to raise money to build a big idea. The problem is that's not investable on its own. A lot of money gets lost before a good idea becomes a reality. a lot of money. I've lost a lot of money investing, even in my own businesses, while I'm trying to turn that good idea, great idea into a viable business. So what that means is what's called early money, which is initial investments, is super risky for investors, and it's very expensive for you. I'll explain that in a minute, but it's one of the reasons why grant funding is going away, because grant recipients have not traditionally generated an ROI from those grants. There's a lot of political arguments about this, which I'm not going to argue. I'm going to specifically speak about it as an investor. But a lot of grants that people have gotten, they have not put that grant money to good use. And as a result of that, many of the grant sources have dried up because there's not a good ROI from it. So what you've got to learn how to do is to stage money, risk, and scale so that you can get an ROI. Now, I'm going to go through how to do all of these things, but I want to stop and see if there's any questions. You can put them in the chat. My team members are here and they'll shout them out, or you can come off of mute and ask any questions that you want so far. But keep in mind, I'm going to show you how to do this in a minute. But questions so far? Lisa, are there any questions in the chat?
No.
All right, so I'm going to keep going. So this idea of going from a big idea to tangible business ROI, if you do not know how to get ROI, return on investment, you're not ready to ask for money. Money invested before you and the business are proven hurts investors, which is why it's considered very high risk. It's a result of all of the grant money that's been given away in the last 10 years that hasn't generated a return, that has hurt those grant organizations, that's causing those grant funds to dry up. And it's considered high risk. High risk money put into a business hurts you because you're going to have to give up too much equity too early. I have seen founders who have raised capital, even smart founders have raised capital, but they had to give up too much equity. And when they couldn't deliver a strong enough ROI, the primary investor took the company, shut it down. I can give you story after story after story where that has occurred. Or I've seen situations where investors put money into a concept, the founder couldn't make it work, and the founder shut it down, and the investors lost money. So this idea of timing really does matter. You don't want to take too much money too quickly. You can spend money easily when it's coming to you from an investment standpoint, but you really don't need as much money as you think you do. You've got to get smarter about the money so that you're not spending it too quickly. And not all money invested is the same. When and where it's invested really does matter. And I'm going to show you what I mean by that. So Shiftco is based on something called the Conscious Business Growth Platform. It's a patent pending process that I developed through my holding company, Share on Purpose. These are the different business phases that we support. And so 0 to 2K is a true startup. When a business is launching, it's 2 to 10K a month. In the shape phase, it's 10 to 30K a month. Build is a very tricky phase, scale it to 1 million, and so on and so forth. Each of these phases—
Are these revenue numbers?
Numbers, yes. So these revenue numbers determine the level of challenges you're going to have in your business. So they're not— it doesn't matter how long you've been in business. It really is what are the challenges you're facing, and what type of funding is the right funding for you. So if you're in the startup phase, you're in what's known as pre-launch, and the type of funding you need is called pre-seed funding, because it's really not a viable business yet. Even though you think it is, it's not. In the launch phase, that's typically what's known as prototype. It's not yet a real functioning business. It's just a prototype. And in that phase, you need what's called seed funding. Again, different. Pre-seed is very different than seed. In the next phase, in shape, that's typically when you need what's known as growth capital, where the business is set up and it's working, but you need to grow it. In that phase, you need what's known as seed funding or bridge funding. So you can see they're very different. In the build phase, that's typically when you're really ready to start the scaling process. And that type of funding is called Series A funding. And then so on and so forth, you go on from there. So I'll go deeper on these different types of funding and where you are in that journey. So in the pre-launch phase, what you're really doing in pre-launch, let me just kind of show you what that is. That's the startup, 0 to 2K. What you're really doing there is you're really just testing your ideas. You're not really building the business. It is very difficult to get funding if you don't have a viable, what's called an MVP, a minimal viable product or a prototype. It is very difficult to get funding in the pre-launch phase, that pre-seed phase. Now, when the grant days were hot and heavy, it was easy to get funding. Those days are gone. In some industries, it is easier to get pre-seed money. But most of the investors that I talk to, and I have a great network of investors, are telling me that they're not doing many pre-seed investments anymore. They want the founders to prove the concept, which means you've got to get smart about self-funding that early phase. In the launch prototype, which is 2 to 10K a month in revenue, that's that MVP. You're launching a beta product. And one of the best strategies is to actually pre-sell the beta. This is a strategy I've used very successfully with several of my concepts. And so I develop the concept and I invite potential clients to join, and they get like a heavily discounted rate by coming in early, and I get to actually test my idea on them. Shifco is actually created that way. And so if you're in that phase, and again, I'll put the revenue phases back up here. We're talking about these first two phases here. If you're here, you're really looking at self-funding options for the most part today, until you can prove that minimal viable product, that beta product. And then the funding options become a little more open to you. In building of the prototype, what you're really doing here is more funding options become available to you here because you've got an idea that actually is stood up. You've got clients who are willing to pay you for that idea. If you try to raise capital for a business where you don't have any clients and you haven't proven the idea, you're wasting your time. It's just, you're not going to find those funding sources very easily today. You've got to figure out how to get it stood up, get a prototype built, and get some initial clients. And then it makes it a lot easier to raise capital. When you're ready to grow demand, that's when you can start getting serious money. And that's when you're really going to assess real demand. And then ultimately, when you want to build the team, that's Series A. And that's when the business typically takes off. Now, we're going to go deeper into each of these and talk about the different types of funding that are available at these different phases, but I want to stop and see if there's any questions so far. All right, moving on. So let's talk about the different types of funding. In this case, as you look at this money tree that I've got out there, you've got to begin to think about the ROI because investors want an ROI. So tie your funding strategy to the business stage to generate the ROI. First is friends and family. It's a great place to start when you're getting started. That's part of a self-funding strategy. People who know, like, and trust you can invest or loan money during a pre-launch phase. Great place to start. Grants and contests. Now, there are a lot of grants, which are great for pre-launch or launch. The caveat is very few of them are doing pre-launch now. They're almost always saying, show me you can actually get the idea stood up on your own and generate revenue. And a lot of the grants and contests make you actually have revenue before they'll give you money. Credit, debt, and microloans are coming back strong, especially microloans. Microloans are coming back in a big way. There's a lot of nonprofits that are doing microloaning again, especially as the interest rates come down. This is a good option if you're wanting to self-fund, but you have to have good credit rating. You have to have a viable business idea, and they really do want to see that you've either got collateral or that you've got some initial clients stood up. But microloans, you can search that on Google, you can Google that term. That is a really good option, especially as interest rates come down. And interest rates are expected to come down globally as well as in the US significantly. As you get a little bit further, there's something called sweat equity. I am a huge fan of sweat equity, and I'm a huge fan of a product called slicing pie. What slicing pie does is it allows you to give away pie slices for somebody giving you something in return. They can give you money, they can give you relationships, they can give you effort, they can give you clients. I'm a huge fan of sweat equity and a huge fan of the product called Slicing Pie. Slicing Pie, there's a book. He has a training class on it. I highly recommend it. It is a great way to get your product stood up. And it's fabulous for pre-launch, launch, or shape phases. So big fan of that. Everything that I do going forward is going to have Slicing Pie and sweat equity in it, because it really does allow the investment dollars to go further. Next up is crowdfunding. Crowdfunding, there's several different types of crowdfunding. The one most people are familiar with is called Give Get. Give Get crowdfunding is I'm going to give you the first release of the product in exchange for pre-funding. Crowdfunding is a good strategy once the idea is stood up. If you don't have a product, a prototype, it's hard to get crowdfunding. It's also way competitive. It used not to be this competitive. It's very competitive now. It's difficult to get, but it is a good strategy to get money in the door. There are several great crowdfunding platforms out there and that do give get. The second type of crowdfunding is different. It's equity crowdfunding. This takes a lot of time and effort. It also takes relationships. It's better suited if your business is further along in that shape or build. So you've got like 10, 20, 30K a month in revenue. Equity-based crowdfunding is really good. If you're not there, if you're back at those earlier phases, you could check out Give Get crowdfunding. After that, you're looking at things like growth capital, where you're really going to build the team. Angel funds are good for that. Private equity is good for that. And venture capital is good for that. Now, this is the key, because most people have heard the term angel funds and they think that angels just literally fly out of the sky and write you a check. What I'm telling you is that is not how it works. For an angel fund or an angel investor to invest in you, your business needs to be probably at least above 30 to 50K a month at a minimum before angel investors will even touch it. Private equity usually won't touch it unless the business is closing in on $1 million. And venture capital used to fund at the pre-seed level, but most of the venture capitalists I'm talking to are saying, no, we'll only invest when the business is further along. So as you can see, the landscape has changed a lot. What I'm going to do next is I'm going to talk about how to raise capital now that we've talked about the different types of capital and where they fit. Does anybody have any questions about the different types of capital and where they fit before I talk about how to raise capital?
Very quickly, what's the difference between crowdfunding and equity-based crowdfunding?
Yeah, with crowdfunding, it's either a donation or a loan, a microloan crowdfunding. In equity-based crowdfunding, you're actually investing with what's called a SAFE, S-A-F-E, and in exchange for equity. It's a very important distinction if you're looking at crowdfunding. So crowdfunding could be things like Kiva or things like that, where it's a donation. There's also micro lending crowdfunding, where I'm going to get the money back. There's a phenomenal platform that does that. Equity is I'm actually putting money into your business in exchange for what's called a SAFE. It's kind of like a note that allows me to have equity in your business, but it's sourced off of crowd. I'm not raising it from people that I know. I'm doing it from the crowd. This is hot in the UK. Equity-based crowdfunding is hot in the UK. It's hot in Canada. It's okay in the United States, but in Europe and the UK, equity-based crowdfunding is very popular. In Canada, it's very popular as well. Alex, that was a great question. Other questions before we talk about how to raise capital? Okay, so let's talk about how you do it. Here are the things that you need. One, you have to solve a real problem that can scale. Most of the time when people talk to me about, Terri, we invest in my business, and I'm like, great, what's the problem you solve? They can't articulate it. It's too generic. And then the bigger problem is they can't articulate how they scale it. Investors only make money when you solve a real problem, so people want your product, and when you can scale that. And that is why most investors lose money, is because the business is a great idea, but it doesn't solve a real pain point, or it can't actually scale. So that's your first test. Do I solve a real problem that people are motivated to solve? And can the business actually scale? The second thing, these are the 5 things that you have to have. You have to have a clear target market. The target market can't be who you serve. It has to be who will pay you. Second is you have to have what's called product definition, packaging, pricing, positioning. Third is you have to have what's known as a growth strategy. How are you going to scale the demand side? Fourth, you have to have a very well thought out financial plan. And you have to understand revenue, costs, profit. And then fifth is you have to have a funding strategy. You can't just do what you used to do in the old grant days when grants were a dime a dozen. You really have to have a funding strategy. It's called a funding roadmap to show how you're going to get from point A to point B. Here's how you build that. So for market definition, product definition, and growth strategy, what you're asking yourself is, what's the problem I solve, and how do I solve it better than what's out there? And the guidance that you need in order to do that is a lot of research, but also that's why I recommend doing a prototype. Get it stood up, try to self-fund that initial prototype, and show that you solve a problem better than anybody else, and then show that you can solve it. If you can do those 2 things, it's a heck of a lot easier to raise capital. And then, incidentally, we do provide the tools and training to do this. So we have multiple pathways. I am the personal coach on that. If you want help doing it, it's $235 a month. There's no long-term commitment, but we do have training and coaching to help you do it. The other place that I would recommend in North America is an organization called SCORE, SCORE. So if you can't afford the $235 a month to have us help you, I would encourage you to go to SCORE, SCORE. It is a nonprofit, and they will help you build these pieces right here. SCORE will help you build those for free. And they have mentors that will help you do it. It's a great place to start. If you're not really sure about your business, start with SCORE. And then once you get the free stuff from SCORE, you can hire Shiftco, or there are other organizations that help you do that. But these are the fundamental pieces that you absolutely have to have. And again, SCORE is SCORE. It is very, very well known. Questions about that, and then I want to talk about one of the most important pieces, which is really what you have to have on the inside of you. These are the strategy pieces you have to have, but I want to talk about what you need on the inside to make this work. But questions about this or questions about SCORE?
Do you work with SCORE, or are your services and theirs mutually exclusive or complementary?
Yeah, I think they're very complementary. We've had people start with SCORE and then come to us. For us, it's speed, because this is our business. So you're going to get in, you're going to get the pathways. I'm going to personally work with you. Many cases, I'll make introductions, to funds and things like that for you. Whereas SCORE, it's a volunteer and they're helping you. But if you can't afford $235 a month, I would say absolutely start with SCORE. There's no other place that I would send you that gives away these types of things for free other than SCORE. If you can't afford the $235 a month, we're going to get you there. Typically we'll get all the tools set up in a couple of months, and then we're usually helping you make introductions to those places so that you can get what you need. Other questions? All right. So I told you at the beginning, I'm 60. I've been doing this for a long time. I started my first business on my own in 2002. Prior to that, I had helped take a company public on the NASDAQ stock exchange. Prior to that, we raised a seed round of about $1 million in venture capital to build a software company. And prior to that, I did my first startup with another founder and lost a lot of money. So I've been doing this for a long time. And I can tell you there's only two things that you need beyond those technical pieces. These are the inner game that you have to have. First is perseverance. So when I started my first business in 2002, I failed miserably for the first couple of years. I was about ready to quit. I hired a coach. Her name is Nancy. And Nancy gave me this task. She said, go interview 10 entrepreneurs and find out what they have in common. So I did that. And I was like, well, that can't be. The only thing they have in common is perseverance. And I brought that back to her and she said, go interview another 20. Well, I ended up interviewing 100 founders. And the only thing they had in common was perseverance. They refused to quit. And I had a wake up call that day after 2 years of failure in my business. I said, I'm going to do this and nothing is going to stop me. And lo and behold, I've had a great career as a founder from that point forward. The second thing is an obsessive, and I mean obsessive focus on doing a few things well. It's not about the millions of things you need to do. It's really about doing a few things well. So what I have found, with how many years now, 25 years as a successful founder with multiple exits, including an IPO, this is what you need on the inside. So perseverance, refuse to quit, and an obsessive focus on doing a few things well. When I needed to raise capital, I didn't know how to do it. These things that I put up here a minute ago on what you absolutely have to have, I didn't know how to do those things, but I learned how to do them. These things about fundraising that I taught all these different funding sources, I didn't know how to do that, but I learned how to do it. Why did I learn how to do it? Because I refuse to quit. And secondly, I have an obsessive focus on doing a few things well. So that's what you need to be successful as an entrepreneur. And what I would say is that that obsessive focus on doing a few things well it doesn't come natural. Because corporate America doesn't teach us these things. A typical job doesn't teach us these things. And when we become a founder, it feels like there's millions of things to do. And there are, but there really are only a few things that you absolutely have to master. And it's knowing what those things are and obsessively focusing on those. That's what makes it successful. So what I look for when I invest in a business, and your Izzy is a great example of that. The founder refused to quit. And I loved that, but he had trouble with focus. I wouldn't invest. I loved the product. I helped him. I gave him some free coaching, but I wouldn't invest. It wasn't until he demonstrated that he had the ability to obsessively focus on doing a few things well that I put money in. So that is essential for your success, are those two things. So I'll just remind everybody, you're welcome to attend any of our events for free. Highly recommend the Gather and Grow event. You will meet lots of founders. It's our largest, most well-attended event. You'll get great ideas. You'll leave that uplifted and excited. So Gather and Grow is our most popular event. It's great. And again, you'll meet lots of people. And then also Purpose and Profit on September 25th. What other questions do you have about raising capital that I can answer for you today?
I have a question.
Yeah,
So I'm a veteran. I was wondering if you are familiar with any of the veteran benefits. Okay.
absolutely, I am. And if that's the avenue you're going to go, I would encourage you to do it this year because their funding sources are going to be cut next year.
Okay. Thank you.
Other questions? That was great, Destiny. Other questions? All right, you guys. Well, we'll send you the recording. Thank you so much. Feel free to connect with me on LinkedIn. I have a great network, and I'm always ready to help people in any way that I can. Like I said, if you want help building out those pieces I talked about, you can join Shiftco for $235 a month. If you can't afford that, don't go any other place other than SCORE, because that is the best free resource that's out there. Thanks, you guys. I look forward to helping you in any way that I can. And again, let's make sure we're connected on LinkedIn. Bye, you guys.